Hey all, welcome to Share Trek. This is Raj here. In our previous video, I spoke about how gold could be a potential hedge for inflation and how gold would be more useful for non-US citizens as compared to US because the price of gold might go down as gold holds the value and the US dollar becomes stronger. So given that, I had also mentioned that we'll do some ETFs that can hedge against inflation. That's exactly what I'm going to talk about in today's video. I'm going to give you a bunch of ETFs that are capable of hedging against inflation plus providing some returns because gold does not provide any return. A little bit of ETF that can move up along with inflation and also provide some returns would be a little sweet. At the end, I will also talk about a potential portfolio where approximately 55% of it might be comprised of all these assets. Depending on how aggressive you want to be, you could limit it to as low as 10%, but I'll give you a whole lot of options out here. And again, these are all my personal opinion and not financial advice, so I request your feedback as well in the comment section. That said, let's get started. Welcome back. Today we're going to talk about tackling inflation with gold and ETFs, a strategic duo. Inflation is often referred to as the invisible tax, slowly eroding the purchasing power. In your portfolio, addressing inflation requires a combination of traditional approaches and modern tools. Gold, long seen as a dependable hedge, now has a host of ETF companions that can enhance your defense against inflationary pressures when used in conjunction with gold. Gold is a timeless inflation hedge. It has always been a trusted asset during times of inflation and currency devaluation. Its intrinsic value, unaffected by monetary policies, makes it a go-to option for preserving wealth. Historically, gold has performed well during periods of high inflation, such as the 1970s and post-2008 crises. However, it has got drawbacks. Gold prices can swing significantly influenced by geopolitical events and central bank activity. Unlike bonds or other financial instruments, gold does not provide income or any returns. And this is where modern inflation hedging ETFs step in as complementary tools or substitutes. The first one I would like to talk about is VTIP. The Vanguard Short-Term Inflation Protected Securities ETF, VTIP, is an excellent partner to gold. The ETF invests in US Treasury Inflation Protected Securities or TIPS, TIPS, with short durations, meaning its value adjusts directly with inflation while minimizing interest rate risk. And the key benefits include VTIP's one-year return, which has been at 5.87%, keeping pace with rising inflation. VTIP provides income from coupon and payments and inflation adjustments, and unlike gold, it gives you some returns. With an expense ratio of 0.04%, VTIP is a cost-effective solution. And then we look at the other benefits from VTIP. VTIP serves as the portfolio's foundation for moderate inflation scenarios, providing stability and income, while gold handles extreme inflation or crises. Beyond VTIP, there are a bunch of other ETFs also that you could consider to further enhance your portfolio. Consider adding some of these ETFs that hedge against inflation, but using different mechanisms. So if you have a particular view of the economy and its various moving parts, and you consider certain sectors to be better than the others, then looking at the rest of the ETFs that I'm going to talk about will provide you better choice to suit your convictions. So the first one I would say is iShares TIPS Bond ETF or TIP, similar to VTIP but with a broader range of TIPS and longer durations. TIP offers a more substantial yield, ideal for long-term inflation protection, and it has an optimized portfolio. Invesco DB Commodity Index Tracking Fund or DBC is the next one. Inflation often stems from rising commodity prices. DBC provides diversified exposure to commodities like energy, metals, and agriculture, making it a direct inflation hedge. And then the next one is going to be SPDR Gold Shares or GLD. For those seeking additional gold exposure in ETF form instead of the physical gold, GLD is a convenient way to track gold prices without holding the physical asset. And then of course we have Vanguard Real Estate Fund or VNQ. Real estate typically benefits from inflation due to rising property values and rents. VNQ focuses on REITs, providing another layer of inflation protection. So those are some of the ETFs that I could think of. There's one more that comes to mind, which is SPDR fund, Energy Select Sector, XLE. Energy prices often drive inflation. Oil price may go up, and XLE provides exposure to major energy companies that can benefit from rising oil and gas prices. So that's another ETF one could consider. And creating a comprehensive inflation defense requires a balanced approach to inflation hedging, which could look something like a combination of all of them, depending on how aggressive you want to be or how fearful you are of inflation. For instance, you could consider gold either as an ETF or in physical form, 5 to 10% of your portfolio. Then VTIP, 10 to 15% for steady, moderate inflation hedging with income. And then commodities, DBC, 5 to 10% to counter rising raw material costs. And real estate, 5 to 10% for inflation-linked proprietary income and appreciation. You could also consider XLE, 5 to 10% for exposure to inflation-driving energy markets. This diversified mix, based according to your own convictions and your own apprehensions about what the inflation might look like and what part of the economy might drive the inflation. You could pick and choose among these things and make sure that your portfolio is equipped to handle varying inflation pressures, from moderate price rises to hyperinflation. So to conclude everything, I would say that inflation insurance for modern investor can be achieved by combining gold with these inflation hedging ETFs. You build a multifaceted strategy that addresses inflation complexities depending on your theory of where the inflation is going to come from. Gold provides stability during crisis, but it doesn't give any income. VTIP ensures consistent returns and provides some income. And ETFs like DBC and VNQ capture inflation-driven growth from commodities and real estate. Together, these assets create a resilient shield, ensuring your portfolio stays strong against the invisible tax of inflation. But at the same time, you have a responsibility to switch gears when you foresee that inflation is going to be replaced with deflation or recession, because you have to be agile to move. You have to keep that thing in the mind. It's not once done and forgotten. You have to constantly monitor the portfolio. Well, friends, these are my thoughts, my personal opinion. It's not financial advice, but I would like to hear from you. What do you think about this? Are you planning any kind of inflation hedge? Are you at all afraid about inflation based on Trump 2.0? Or do you think that maybe inflation might not happen and things are going in the way that they are going right now and will continue to keep on tapering off? I'd like to hear from you, and please put your theories in the comment section. I really like to read them. With that, my friends, I'd like to bring this video to an end. Thanks and have a great day. Bye for now.